This is the Coronation Podcast.
Across Nigeria, many organizations hold significant levels of idle cash, not because there are no opportunities, but because of deeper challenges with liquidity, risk, and decision making. And in today's environment, that really comes at a cost. When you factor in inflation and currency dynamics, idle cash is no longer neutral. It is quietly losing value in real terms. So, the real question is, how should corporates be thinking about cash differently today? Welcome to Coronation Insights, where we explore the ideas, strategies, and decisions shaping today's financial landscape. This particular episode is part of our portfolio strategy series, where we unpack how to approach these decisions more strategically. I'm Vivian Zanu, and today we're looking at a question many corporates, don't ask often enough, which is your cash working for you or quietly losing value? To help us break this down, I am joined by Joy Enyi, Team Lead Institutional Sales at Coronation Asset Management. Joy is someone who works closely with corporates on structuring cash and liquidity strategies. Joy, great to have you here.
Thank you, Vivian. It's great to be here.
Okay, so let's start from the core issue. Why do so many corporates still hold significant idle cash even in today's market?
That's a very good question. So what we're seeing today across the market is that many corporates are holding more cash than they actually need.
Okay.
And it's not because there are no options, but rather because the liquidity is often misunderstood. For many treasury teams, liquidity is equated with inactivity, keeping funds untouched. But that approach comes with a hidden cost, especially in an environment where yields are elevated.
Okay, that's interesting. Because on the surface, holding cash often feels like the safest option. So, where exactly are corporates getting it wrong? Is it a knowledge gap, or is it a risk aversion, or something structural?
I would say it's a combination of both, but I would say the biggest issue is mindset.
Mindset.
Yes, because many corporates are still operating with a very conservative view of treasury, prioritizing safety without considering the opportunity cost. So, what leading organizations are doing differently is structuring their cash,
Okay.
separating what needs to be immediately accessible
Okay.
from what can be deployed more efficiently.
Okay, let's bring this into today's market environment. What should corporates be paying attention to right now?
In today's Nigerian environment, when you factor in inflation and currency dynamics, idle cash is not just inactive, it's losing value in real terms. And at the same time, yields on short to medium term instruments are relatively attractive. So, what this creates is a clear opportunity. So, corporates can now structure their liquidity in a way that preserves value and generates returns without compromising operational needs.
Okay, so let us take this a step back. How should a corporate be thinking about cash differently today?
I would say the starting point is segmentation.
Segmentation.
Yes, segmentation.
Okay.
Not all cash serves the same purpose. So
Alright.
typically, corporates have operating cash, which is required for their day-to-day activities, the liquidity buffers for short-term obligations, and surplus capital, which is not immediately required. The challenge many organizations have is treating all three the same. That's keeping everything in low yield accounts.
Meaning they do not use the segmentation approach.
Yes. But once you're able to make that distinction, it becomes much easier to deploy surplus capital more strategically while still maintaining liquidity where it's needed.
Okay. So, for a corporate listening today, this makes sense conceptually, but execution is often where the challenge lies. So, what does this look like in practical terms?
Okay, so if I'm to simplify this, there are 4 key steps. The first will be to understand your true cash position. And then the second step will be to define your liquidity requirements. And the third will be to align investments with these needs. And the fourth step will be to implement a structured review process. Because treasury strategy should be dynamic, not static. Yes. Yes. And without that structure, capital either remains idle or is deployed inefficiently.
And well, I imagine this is where many corporates struggle. Not in understanding the concept, right, but in actually implementing it.
Exactly. Execution is where structure and expertise become critical. At Coronation, we work closely with corporates to understand their cash flow patterns, liquidity requirements, and risk appetite. From there, we design solutions that allow them to deploy surplus cash efficiently. For example, where liquidity is critical, our money market funds provide accessibility with competitive yields. And for more structured allocations, portfolio management allows for tailored strategies. And then for corporates that want direct participation, execution provides access to specific opportunities. But ultimately, it's not just about products, it's about building a structured approach to treasury management.
Okay. I can see that we've spoken a lot about putting our investments or tailoring them into a structured approach. So I think that it's a very important point. It's not just about having the cash, it's also about how that cash is working. And in today's environment, leaving funds idle is no longer a neutral decision, it's a strategic one. Joy, thank you so much for sharing these insights.
Thank you, Vivian. It's been a pleasure.
And to our listeners, thank you for joining us on Coronation Insights. If you'd like to explore how to structure your corporate capital more effectively, you can reach out to the team at Coronation Asset Management at institutionalsales@coronationam.com. Please note that this podcast is for informational purposes only and should not be considered investment advice. And remember, smart capital doesn't sit idle, it works. Until next time, invest wisely.
This has been the Coronation Podcast. Thank you for listening.